Right, let's get a sense of what's moving the markets. I'm joined by Trevor Garvin, who's head of multi-management Nedgroup Investments. Trevor, very good afternoon to you. Always a pleasure to have you on the show. The US-Iran tensions remain a major driver of oil prices, with Brent trading around $90 to $92 a barrel. I mean, the US has now stepped up economic pressure on Iran, including expanding sanctions, while the risk of further disruption around the Strait of Hormuz remains. How concerned should markets be about further supply disruptions?
Hi, good afternoon, and great to be with you again. So yes, I think you raised some good points there, and actually what we've seen the last few days is the markets looking a bit more favorably onto the situation there. What America has been doing, which is a little bit now of a new tactic of theirs, is that they are trying to squeeze Iran economically as opposed to now through military action. So with extreme heavy sanctions on Iran, as well as maintaining control over the Strait of Hormuz, they are really trying to minimize any oil going in or out to Iran, and therefore getting the economy of Iran really on its knees. And it seems to actually be working, and overall markets are looking at this as quite a favorable thing, and we've seen the Brent crude price come down over the last few days. So it was around $93, $94 per barrel, and now today it's sitting on $89. And what's really quite amazing to see is the rand, as you sort of read out just now, just an hour or so ago, broke through that 16 rand to the dollar mark, so sitting at 15.99 as we speak. And that's a little bit of a breakthrough level, and I suspect possibly the rand could continue to strengthen a little bit over the next few weeks.
Yeah. So South Africa's latest inflation numbers show it sitting at around 4.3%. What does this now mean as we take a look at the ripple effect for fuel prices, inflation, and ultimately the cost of living for consumers and businesses?
Yes, so of course a high fuel price hurts the consumer. They need to pay more every time they go and fill up their tank of petrol or diesel at the station. So consumers are under pressure with this higher Brent crude or petrol price, and that puts a little bit of a damper on the economy. If we think back 6 months or so before the war started, South Africa was really on quite a nice upward trajectory with our economy growing, and we were heading sort of towards about 2 to 2.5% GDP growth. And now, unfortunately, with the war and the higher oil prices, high inflation, it slowed things down again, and we're back to probably looking at 1 to 1.2% growth, which is not great. And yes, higher inflation, higher petrol prices, and we saw it from the South African Reserve Bank. They've put interest rates on hold for the moment. They were on a cutting path, and now we think that there's quite a high probability that perhaps when they meet in September, in a couple of weeks' time, there's a chance that interest rates may go up by 25 basis points, which will put a further damper on the economy and economic growth.
At the same time, while we're still talking about aspects of the US, I mean, President Donald Trump's implemented tariffs of 50% on Canadian imports. How significant is this latest move? And is it perhaps the start of new tariffs across multiple countries?
Yes, well, I mean, we know that he's been threatening this for a while now, and then the US Supreme Court's actually put a bit of a damper on his policies, and he had to land up giving roughly about 10% tariffs over the course of the last 12 months or so. And then just last week, he implemented a 50% tariff on some of the Canadian imports. As it happens, it affects probably only about $20 billion or so of the imports, exports between Canada and the US. So it's not a material amount, but I guess it's a good signal for what he's thinking possibly to do across other countries around the world. And it's not great. Tariffs are not efficient from an economic perspective. They create upward pressure on prices. And as we've said all along, the consumer across the world is already struggling. And so tariffs will probably have a negative effect across consumers all across the world.
Absolutely. Now gold, before we let you go, is trading at $4,660 an ounce, having risen sharply the last few weeks. What market implications does this have?
Yes, we've seen the gold price go up recently from about $4,500 to $4,635 or so today. And I think that's all tied in with many of the things we've spoken before. When oil prices are high, when inflation is growing or upward pressure on inflation, people tend to move into gold as really a store of value and as a safe haven towards some of the equity market risks. What we also really see, I think the other key thing that's happened in the markets over the last week or so is that the US bond yields have risen on their 30-year bonds, and it's a sign of the high level of debt that the US government is now in, sitting at about $40 trillion. And they are spending more now on interest on the US debt than they spend on defense and medical combined. So I think that's now the new talking point in the markets.
Thank you very much. Let's perhaps leave it there for now, wrapping up the markets and really just assessing and looking at the impact of the Middle East tensions. Trevor Garvin, head of multi-management, Nedgroup Investments.